Hi, this is John Leonetti, and this is a 10-minute introduction to Pinnacle Equity Solutions' 6-step exit planning process that's being used by hundreds and hundreds of advisors and business owners to assist our exiting owners with setting a proper exit plan from their business. I want to give a high-level presentation of our 6-step process so that our advisors and business owners out there can understand the steps that are involved and take the next step towards engaging in the exit planning process. This process is all laid out in my Exiting Your Business, Protecting Your Wealth book, published by John Wiley & Sons, came out in 2008, and I am the author, John Leonetti. The subtitle is A Strategic Guide for Owners and Their Advisors. Now, the book was put into 3 parts to help advisors and owners engage in the process of planning for their exit. Part 1 is the preparation for the exit. Those are the first 4 chapters. Part 2 explains the options for exit. There are 5 chapters there. And Part 3 is about execution and protecting the wealth, which are the technical sections dealing with deal structure, taxes, estate taxes, advisory teams, legal agreements, and how to pull this all together. I'm going to walk you through the different steps that are in our system, and they're all throughout the book. Now, Part 1, Part 2, and Part 3 all work together, and it's all available for a simple read for Exiting Your Business, Protecting Your Wealth. I'm going to give you the high level here. Our 6-step process starts with step number 1, which is setting exit goals. And there's nothing more important in an exit planning engagement than understanding the business owner's goals. What is it that the owner wants to achieve with their exit? If we can get really clear on what's trying to be achieved, that sets the foundation for the rest of the planning work. The second step, naturally, would be how ready is that business owner to meet those goals? And because every business is different, we lean on 2 criteria that are personal in nature: the owner's financial readiness and their mental readiness. And that will tell us the readiness to meet their goals. Based upon those 2 criteria, we identify the type of exiting owner that we most resemble, and then from there begin to pull together and define how we can start to engage in this process. The 4th step, once we know what type of owner we are based on our goals and readiness, is to learn about the different options that there are for exit. There are many options that you can choose for to exit or transfer your business, so we want to learn about those and figure out which one's the best fit based on the type of owner you are. You have to understand that each different option has a different value, so we want to understand the value of the option you choose. You can't go very far with this type of work unless you understand the different values that you're going to get based upon the different transfer options. And then finally, as we say in exit planning, it's not what you get, it's what you keep. The execution, or the 6th step, is dealing with deal structuring, taxes, estate taxes, and the overall protection of that wealth. Remember, the title of the book is Exiting Your Business, Protecting Your Wealth. We're trying to do both in this engagement. So, again, the first part of the book deals with steps 1, 2, and 3, which we're going to take a look at now. Step number 1, setting owners' goals. The focus here is entirely on what the owner is trying to achieve with their exit. What does that mean? Well, about 30 or 40% of our exit planning engagement is going to be based upon assessing what the owner wants to do. And this isn't easy for any owner to know exactly what they want to do. Owners know how to run their businesses, not necessarily how to exit them. So it's very difficult for an owner to begin to understand what their life is going to look like after the business, how they're going to keep busy, whether or not they're going to have enough money, whether their children want to continue with the business, whether they want to give it to the management team, and so on and so forth. As a result of that complexity, a lot of this planning work doesn't get done. It's important to set the proper foundation and get the goals straight. We commit a lot of time to understanding the significance of a transition from ownership to post-exit lifestyle. Let's talk about that. A business owner is going to transition from running the business and owning it to moving to a different phase of life. Now, they may sell a portion of the business. We'll see at a private equity group and continue working. They may sell all of the business. They may transfer to their management team or their children over a number of years to their employees in an ESOP, but it is a transition. And the owner has to understand that they're moving to a different phase of life. What are the goals that they would like to achieve with that? We come to understand the value of having this conversation and walking the owner through this step. Because if owners cannot get through the goal setting, it's very hard for them to determine what direction they want to go in. And finally, we see how the value turns into the price that an owner will pay for this engagement. The value is immeasurable. It comes down to what the price is going to be, and that is how an owner engages and moves ahead. Now, based upon their goals, we want to take a look at their financial and mental readiness. These are the two criteria for virtually any exit strategy plan. We see that based on the financial readiness, we look at the chart, and on the left-hand column, we put financial readiness, high or low. We also take mental readiness, which is high or low, and we plot a point on that chart. What that means is if a business owner has saved little money outside their business, they have a low financial readiness. By the same token, a business owner who doesn't want to stop working right away has a low mental readiness. And based on these two criteria of financial and mental readiness, we can identify our business owner as one of 4 types of exiting owners. And that's step number 3. At this point in time, what we're trying to do is take a look and say, what type of owner do we have? Do they have a lot of money saved? Are they well off but choosing to work? Do they have no money saved and really want to stop working, get me out at the highest price? If we can begin to put a business owner in one of these categories, and they don't have to be exclusively in one, but if we can just use this tool to begin to organize the planning process based on the criteria of financial and mental readiness and the goal setting, what we can do is we can move to part 2, steps 4 and 5, learning the options for exit. Now, it turns out there's 5 exit options. There's a sale of the business, private equity recapitalization, ESOP, management buyout, and a gifting program. Now, what you'll notice that's not on here is initial public offering. That's a company that grew so big that they decided to access public equity and debt by going public, by doing an initial public offering. On the other end of the spectrum is a business that failed for any reason and wound up selling off their assets. That's liquidation. Well, between those two extremes, liquidation we don't like and IPO isn't realistic, these 5 options are what we're left with. The business can be sold, an investment group can come in, or we could set up an ESOP to sell the stock to and have the employees benefit. We could do a management buyout, or we could do a gifting program. And we're going to take a look and see where each of these fits into the quadrant, because once we have these 5 exit options and we understand what type of owner we have, we can begin to assess where the owner fits in the quadrant. For example, an owner who has not saved a lot of money and wants to keep on working might choose to do a PEG or private equity group recapitalization, take some chips off the table by selling a majority of the business, but enter an employment agreement and keep working. By the same token, the owner who wants to do a management buyout, we recommend should have a high amount of financial readiness, because if that business owner is dependent upon the business for their post-exit lifestyle, they have to recognize there's a lot of risk with turning it over to the managers, because the managers, all things equal, are not going to have the cash to pay for the business up front. That's step 4, learning the exit options and applying them to the type of owner that we have based on the goals that are trying to be achieved and their financial and mental readiness to achieve them. Now, our range of values, again, comes to recognize that there are different valuations for a privately held business. And what all of this planning goes to do is assess whether a business owner will transfer the business internally or externally. An internal transfer will include gifting the business or doing an ESOP, and that will get an appraised value called fair market value. That's done by a professional appraiser, and there may be discounts that apply to that valuation for minority transfers. Now, an external transfer is the sale to an outsider such as an investment group or somebody in your industry, perhaps a competitor. We call that market value, and market value is simply what the market will pay for this business, and it's either investment or synergy value. Investment value is the value of the entity's cash flows discounted according to the risk, and which would be a private equity group purchase that keeps all the pieces of the business. Synergy value is perhaps a sale to a competitor who cuts some jobs and cuts some expenses and gets the additional profitability. And the business owner who chooses synergy value needs to understand that they may not want to see those jobs cut or the certain vendors eliminated from the business. So selling to a competitor and getting the highest price might not be what they really want. And our exit planning process helps the business owner weigh the pros and cons of each of these, gives a value. Our deliverable gives each of these values, fair market value, investment value, and synergy value, so that the business owner can make a decision to figure out if they're going to reach their goals based upon the direction they head in. Another way of saying that is the business owner chooses the value that they get by the direction that they choose to transfer their business. And finally, when we know which direction the business owner is heading in, which option is best, whether or not the valuation is enough, we have to go to the point, which is part 3 of planning your exit, protecting your wealth, which is our last step, to go to the main theme that it's not what an owner gets, it's what they keep. We want to measure the taxes. We want to measure estate tax liability. We want to take a look at the deal structure. We want to take a look at the legal agreements. And we want to make sure that the advisors are all working towards the owner's goal. And we pull this all together by, number 1, preparing for the exit, taking our system and our steps. Number 2, learning the options for exit. And number 3, going through all the technical areas that could reduce that wealth so that we can protect it. In short, a business owner who plans in advance for their exit will take the time to do both the preparation and learn all of their options and all of the obstacles that could reduce their wealth. And in doing so, that business owner will set a plan for the exit from their business and simultaneous protection of their wealth, taking care of their personal, business, and family obligations, all with one plan. The importance and need of exit planning has never been greater as our baby boomers are moving into retirement, and I hope that this short overview of Pinnacle's 6-step exit planning process will encourage you to begin to do your own exit planning today. This is John Leonetti for Pinnacle Equity Solutions describing our 6-step exit planning process. Thank you. Second step, we would ask,